It's a big day in Nigeria. We call it Decision Day. The Monetary Policy Committee of the Central Bank of Nigeria has been meeting since yesterday. Today, we hear the decision they will make that will run the country for the next 2 months before the next meeting. That's the major focus right here on Business Incorporated. You're welcome. I'm Ini John McCoy. It's going to be a long one, so do stay with us because we'll also hook up to the central bank when they will make that decision, which is just in about an hour or less. But before we head there, now let's tell you some of the things happening, especially in the global space where oil prices fell in early Asian trade on Tuesday, with investors anticipating higher for longer U.S. inflation and interest rates that will depress consumer and industrial demand. Look at the number right there. It's red, even though it's not so deep in red, 0.01% at $83.34. That's for Brent. WTI, $79.72, and that's also 0.01% down in the red. Both benchmarks fell less than 1% on Monday, as U.S. Federal Reserve officials say that they were awaiting more signs of slowing inflation before considering interest rate cuts. Does this mean that it's not going to be in September anymore? Well, I don't know. We're still watching. Federal Vice Chair Philip Jefferson has said that it was too early to tell if inflation slowdown is long-lasting. While Vice Chair Michael Barr said that restrictive policy needs more time. Atlanta Fed President Raphael Bostic said it will take a while for the central bank to be confident that price growth slowdown is sustainable. So this, no wonder the market is red. The oil is in red. I guess that the market in the U.S. also and Asia will also be red. But there are also other factors driving that. Oil marketers are weakening because of soft refinery demand and ample supply. Traders and analysts say that this could spell further weakness for benchmark crude futures. On the other hand, the markets appear little affected by political uncertainty in two major oil-producing countries. And of course, we know that investors are also focusing on the supply cuts by OPEC Plus. They're scheduled to meet, OPEC Plus that is, to meet on June the 1st to set output policy. Most likely they will extend some of those voluntary cuts, which might take about 2.2 million barrels of the market. So a lot of factors driving the price at this time. From there, we go to gold, where prices rose to an all-time high. This started yesterday, on Monday, as a cocktail of factors. From the United States rate cut expectation we just talked about, to China's stimulus measures, to geopolitical tensions. They lifted demand, with the momentum also carrying silver to a more than 11-year peak. You see the numbers right there. It's up. Spot gold, that is, 0.9%, $2,437.96 per ounce. U.S. gold is also up about the same percent, 0.9%, that is, at $2,439.59. Also, U.S. gold futures settled at 0.9% higher, and we know that the value of the dollar, increased holdings in China, which has led to more demand coming from China. They have fed into those numbers. Also adding to gold's upside was elevated risk aversion. That unfortunate incident, the Iranian President Ibrahim Raisi, that died in that helicopter crash. That, of course, is a consideration for a whole lot of investors. Meanwhile, some analysts are also pointing out gold surge to China's announcement of historic steps to stabilize its crisis-hit property sector. And we know that demand has increased from China's part for gold. So China is a key consumer of gold and other industrial metals. We look at silver now, and the price is also up 2.2%. To $32.17 a barrel after hitting over 11-year high. All right, now it's MPC Day, as we've said, so we do a little bit of everything, but more of the MPC. Let's go to Berlin now, see what's happening with the European market. We have Lars Holter to just give us the market analysis for today.
Thanks for having me, Ini. So the ruling came from a Russian court in St. Petersburg. They have ordered the seizing of assets of Germany's Deutsche Bank and a Commerzbank. And to clarify, the assets those banks have within Russia. Officially, this is in response to a lawsuit over the planned construction of a liquefied natural gas terminal by the Baltic Sea. That had been planned by a multinational construction firm, Renaissance Heavy Industries, and it was later cancelled over the economic sanctions against Russia when the war started. Now, Deutsche Bank as well as Commerzbank were among the guarantors. They were guaranteeing the financing of that project. And now that the project is history, they've been told they would owe approximately 250 million euros in case of Deutsche Bank and 100 million euros in case of Commerzbank. It's not a total surprise for the banks. At least Deutsche Bank said that they've already made provisions for about the amount in question. Well, after a long weekend, yesterday was a holiday in Germany, we're expecting a calm Tuesday as well. There's not a lot of data out there, but we can take a look at producer prices, and they're down a bit for the month of April. Actually, they're down a bit more even than expected, and that is certainly good news in an otherwise slightly inflationary environment. We can expect those lower producer prices to also somehow impact consumer prices as well. So we are having a look at that over the next couple of days, of course. Also, we got some big names in Frankfurt today. U.S. Finance Minister Janet Yellen is there, but not on strict business. She'll be awarded an honorary degree at the Frankfurt School of Finance and Management, and among the guests are ECB President Christine Lagarde and the German Treasury Secretary. They might, of course, discuss politics and the economy, but likely not come up with any news. After all, it's a celebratory event.
Oh, celebratory indeed, Lars. Thank you so much for that. Now, let's come back home. I guess this is the beginning of our major focus for today. Yesterday, the Director General of the Debt Management Office, Mrs. Patience Oniha, was in Lagos to meet with, those who they have to interact with the market. We know that the federal government has been very focused on raising funds domestically to fund the budget. So yesterday she did meet here in Lagos to share updates on what has been raised so far and the plans ahead.
With your support for the new domestic borrowing and the 2024 budget, which I said was 6 trillion naira, we actually have raised 4.5 trillion naira out of that. So it's not our money. You gave us money, and we'd like to thank you for that. For the ways and means, the last time we talked about how we funded your own money, excess cash reserves. Since then, a lot has happened. So out of that 7.3 trillion naira that the National Assembly approved for securitization, we have raised 4.905. So I'm giving you figures as at Friday. We have raised 4.905. So there's still a balance in both cases, so let's see how the rest of the year goes. But let me quickly add that the Nigerian domestic securities market remains a major source of funding for the federal government, really. And we cannot better appreciate the work that we have done collectively all these years. That's why, COVID came, countries couldn't go to the international capital markets. The markets were closed anyway. But we were able to raise the full amount and even more that we needed to fund the budget. And that has been the case. If you think about it, last year we raised 7 trillion naira, as new domestic borrowing. So it speaks to the size of our market, the resilience, and then the sophistication, really. That's not the case for a number of countries in Africa. Some of them don't have a yield curve that extends to 5 years.
Well, that's why a lot of investors have been making some money from the fixed income market, and it seems it's at the detriment of the NGX at this time. But I mean, the good thing is the governments, especially the federal governments in this case, is going to pay less for debt servicing compared to if they were to raise money outside the country. And it also gets investment around for Nigerians and foreigners. Now let's get to London now. It's going to be a quick one. Juliana, good afternoon. It's our MPC day here, so we're very selfish, but we'll give you a little bit of time to see what's happening in the markets in London. How's it doing intraday?
Thank you, Winnie. I've got to say you're quite generous, actually, allowing me to come into your programme on a very important day. Of course, Nigerians in the diaspora are also on tenterhooks. But the markets are in negative territory at intraday. I know we don't have time, but it's important to say that we've got a bloodletting catastrophe, shall we say, going on in the UK. So expect big announcements out of Parliament concerning billions of pounds worth of compensation. Has that sentiment leaked into the market? I presume so. The UK Blue Chip Index, INI, it's down 0.42% at intraday, same as the FTSE 100. That's also down by the same figure. The FTSE 250, the domestic market, down by 0.48%. The British pound is currently rallying against the US dollar. It's up by 0.08%, though it's down against the euro by 0.04% and down against the Japanese yen by 0.09% in A.
So much. I know that you have already kept your appetite wet, so we're going to wait for that big news coming from the UK. I guess we will see it later on tonight, but thank you so much, Juliana.
Thank you, Winnie.
Alrighty, so let's take a break now. When we come back, we'll begin to set the ground for the MPC decision. We'll look at some African countries and see what their rates look like. And perhaps that will challenge Nigeria to do much more. Let's take a break. We'll be back.
The Dangote Petroleum Refinery is going to be the largest single train.
Welcome back. Still watching Business Incorporated, a special edition, as we await the decision of the MPC of the Central Bank of Nigeria. But let's keep our eyes on other African countries, how they've been faring when we talk about their inflation and their NPR and, of course, response of their currency. Aniti Edet has the details. Hi, Aniti. Good afternoon.
Yes, good afternoon, Ini. Yeah, it's D-Day. Finally, the much-awaited third meeting of the central bank's MPC, although we still have other MPCs around the African continent announcing their monetary policy. Some have already done that, but today the central bank is going to announce to the rest of the world that, okay, whether they're going to retain the Nigeria's monetary policy rate, which is currently at its highest level, 24.75%, or maybe they'll shock the world by retaining it, because under the Yemi Cardoso's leadership of the central bank, we've had about 2 interest rate hikes, which is back-to-back from the month of February and the month of March, and that's about 600 basis points to about that level I just mentioned, 24.75%. So, your guess is as good as mine, because
I don't know what your guess is, Aniti.
yeah, well, it's actually a split. It's actually a split, because at some point, some expect that the central bank will retain the rate. Others say it's 100 basis points, while some say, no, it's not going to be that hawkish, because the inflation rate for the month of April didn't come in as high as expected, because initially some analysts had projected it to be about 34%, but then it came in slightly lower at about 33.69%, contrast to what we had in March at 33.2%. So we'll be giving our viewers much of the details, but that's just, I'm expecting that it will be that hawkish. So that's it there. We saw that, and at the last meeting that the central bank had sometime in the month of March, to be precise, that was on March the 25th or so. So they had increased the lending rate all the way from 22.75% to 24.75%. And now today, we're expecting that, well, will they hold? Will they hike? Well, in a couple of minutes from now, or maybe in about an hour from now, we will be seeing the central bank that they're currently meeting right now. So that announcement will be made by the central bank governor, Mr. Yemi Cardoso, who had hinted that high interest rates is going to be maintained in its efforts to curb the country's rising inflation. Inflation is currently at that nearly 30-year high. So the CBN, in its bid to rein in inflation, well, we will be expecting that, well, they will take their decision, which will be announced sometime in a couple of minutes from now. Now, after this meeting, we'll be having the next meeting of the MPC on July the 23rd and July the 23rd. But at the last meeting that they had, in addition to increasing the lending rates to 24.75%, the CBN had also held the reserves, the cash reserves ratio, which is the total deposit of customers, which these commercial banks have to hold as reserves cash. It was retained at 45% for deposit money banks, while the cash reserve ratio for merchant banks was adjusted from 10% to about 14%. At the same time, the liquidity ratio was retained at 13%, and all the 12 members of the Monetary Policy Committee had voted for that rate hike. At the same time, Nigeria's inflation, all the way from 31.7% in February, had increased to about 33.2%. So that's it for Nigeria's market as far as inflation and monetary policy matters are concerned. Next stop is South Africa, where we saw the last time they had the meeting was sometime in March, and for the opt-in time, for about 13th consecutive time, they held the interest rate at 8.25%, which is still high. The central bank governor had already announced that at the last meeting that they would be retaining this lending rate at a 14-year high of 8.25%. And then, of course, by next week, this time next week, we'll be expecting that the SARB, that's the South Africa Reserve Bank, will be taking its decision whether to continue to hold inflation interest rate or to hike it, because at some point the country's inflation rate is moderating. So we see some moderation in some parts of the African continent as we speak. While the country's prime lending rate is currently at 11.75% per annum, and that's based on a repo rate of 8.25%, while the country's long-term bond yield currently trades at about 12%, which is despite moderating inflation. So the SARB had been moderating the interest rate. They've been reducing the interest rate all the way from November 2021 in a bid to stabilize commodity prices before the global monetary policy tightening spree, which commenced sometime in 2022. And next stop is Nigeria's closest neighbor, that is Ghana, which it left the lending rate unchanged at 29% at the last time that they had the meeting, which was on March the 22nd of this year. And then tomorrow, they'll be having their meeting, which begins on the 22nd of May down to the 24th. That's about a 3-day interest rate decision meeting day that they'll be having. Ours is 2 days. It started from yesterday, and of course, today is a decision day. But tomorrow will be Ghana's interest rate decision day, where this is coming after the country's inflation had dropped all the way from 50%, which we saw sometime last year, up to about 25% just last month. Of course, we see that the impact of their monetary policy decision. And don't forget that Ghana had been heavily indebted. They had defaulted on most of their external debt sometime in December 2022, and in January 2024, they had reached a deal to restructure about $5.4 billion of loan with official creditors, including China and France. Now, Ghana is a West African cocoa, gold, and oil producer, which has been restructuring its debts as it tries to emerge from the worst economic crisis which it has faced in a generation. And it was largely supported by a $3 billion rescue package under the IMF's rescue program. So that's it for Ghana's economy. Over to the next stop, we have Kenya, which is another country that has retained its monetary policy rate at about 13%. And at the same time, the country's inflation has dropped all the way from what we had before. We had about a 5.9% to about 5% for inflation. The next meeting of the MPC will be coming up in about about 2 weeks from now, where they'll be having this monetary policy rate. The country's inflation had dropped to about a 3-year low at 5%, which we see on the board there. And this was largely driven by slower growth in prices of food, as well as non-alcoholic beverages. So food inflation in that country had dropped to all the way from 6.85% to what you see here. But when you look at that in Nigeria, we've been having several instances of monetary policy increases. If the central bank should increase the monetary policy rate, it's going to be about the 12th time. But it has been 11 times now, which had started all the way from 2022. So Nigeria's inflation, well, whether it will react to the central bank's monetary policy committee's tightening, maybe the hawkish stand, if that comes up, if it's going to be 100 basis points, Nigeria's inflation rate might come up to about 25.75%, or maybe just around that 25%. But for Ghana, this is where it is at 13%. So the next meeting we'll be looking out for on June the 5th. And the fourth one where we have is the country called Angola, where we see the Monetary Committee policy. Last week they met, and that was on May the 17th. And of course, they raised the interest rate to about 19.5%, with after inflation had risen to about 5%, and they raised the rate all the way from 19%, which it was previously, to about 19.5%. So that was just about some 50 basis points increase on the country's lending rate. And this comes after the country. This is the inflation. The country's inflation rate has risen for about 12 straight months, and this is why the country's monetary policy committee has been hiking the interest rate so far since the last time, which was on May the 17th here, which is for Angola's monetary policy the decision. And now this time, we'll be looking out for, that's in the next 2 months, we'll be looking out for the dates, July the 18th and 19th. What will they do the next time in order to rein in on inflation? Because inflation is a global concern. We've seen, some time ago, we saw the U.S. Federal Reserves, as well as the Bank of England, talking about England, the UK, will be expecting their own inflation numbers to be coming out. And what will the Bank of England do? Well, that's for the Bank of England to decide. But when we look at Angola, inflation is still a major concern. We've had about 2 countries within the African continent, which is under our purview, has seen inflation coming down as a result of the central bank's monetary policy committee's actions or decisions at tightening the monetary policy environment. So, that's it for the countries that is under my radar for on the day that Nigeria's monetary policy committee is having its lending rates decision.
Yeah, thank you so much, Anita, for that.
Pleasure.
All right, so it's obviously a whole lot to consider. So you want to be moved or look at what your neighbors are doing as a country to see how that will influence. We've heard the UK has exited recession. Earlier we talked to you about the United States and the comments that are coming through suggesting that perhaps the world will have to wait longer before those interest rate cuts begin. Initially, it was supposed to be in June, then it now went to September, but even as we speak, it seems we might have to move it further. And of course, this has consequences, especially when it has to do with, the United States and the dollar. it affects everything. So back here in Nigeria, what it affects is our domestic economy. If the MPR is high, then the cost of fund is high, and then it affects, economic growth, funding, businesses. Those who have already taken loans, it costs them more. What happens to sentiment around that? Well, thank God I'm not alone to dissect this. After all, it's MPC Day, so we always have, one day I'll be looking forward to when we have, a women's round table discussing the MPC. It's a dream that will come true. But for today, I'll work with the men. We have here Dr. Biodun Adedipe, Chief Consultant of Biodun Adedipe Consultants. Thank you so much, Dr. Adedipe. It's so difficult to have you in flesh, so we're glad you're able to make it today.
Thank you so very much. I'm happy to be here.
Good to have you. And then over to in our Abuja studio, we have the Chief Economist of Development Bank of Nigeria, Professor Joseph Nana, joins us from our Abuja studio. Good to have you, Professor Nana. I miss talking to you. I think Ladi has been talking to you more these days. It's good to have you, join us for this MPC conversation.
Thank you for having me. I'm happy to be here.
Awesome. So, Dr. Adedipe, let me start with you. This central bank administration is very aggressive. In fact, they've told us they've gone back to the orthodox policy, and they have the 21% inflation target for the end of the year. I think like 2 weeks ago, Mr. Kaduso had told us that, look, it's tightening until we get what we want. But obviously, there are consequences to that. A lot of economists have started talking about the consequences of, too much of a tight. Already we've done 600 basis points.
That's right.
Yes. But we have started seeing a bit of reduction in the pressure for 2 months now, talking about inflation. And then we've also had hints of the CBN also looking at the GDP. We're expecting numbers, I think, next week or
That's
that.
right, yeah.
Do you see this filtering into the decision we should hear in a couple of minutes?
Well, I expect the MPC to consider that, because what matters in this instance is that the rate of inflation, of course, measures how prices change generally. Now, if that rate starts slowing down, it is a signal to the MPC that perhaps the measures they have taken are working, and of course impacting the inflation rate the way they wanted. So, but as you also mentioned, for every major macroeconomic policy decision, there are always outcomes, positive, as well as consequences. So those are the things you don't have to weigh and ask yourself whether you should continue with tightening. And I think that's a very difficult position they are in today. If I were a member of that committee, it's a very tough call. But again, that brings you to the fact that which one would you consider as most urgent? Now, the rate at which inflation rate is increasing has subsided. It's like comparing speed of a vehicle with acceleration. So now, inflation rate has decelerated. It's still rising, but at a slower rate. So that gives them some measure of confidence that what we have done is working. But the question now would be, should we continue along that trajectory? And incidentally, that is what the governor has signaled. We call it qualitative easing. Qualitative easing in central bank is called rate guidance. So he has given a guidance to the market that we still maintain tight monetary policy position. And if that is the case, it means the expectation we have is that there's a likelihood that MPR will be raised again, maybe moderately, not as aggressive as we had at the last 2 meetings. But the flip side of it, like you mentioned, is what is the implication of that for growth? And that's where GDP comes in. Now, naturally, there's a trade-off between growth rate of the economy and the rate of inflation. And the argument is always talking about orthodoxy, is that you cannot eat your cake and have it. So if you want to pursue inflation and knock it to the hole, you must be ready to also take, some measure of, let me say, some cost with respect to growth of the economy. If you want to pursue growth equally, you cannot run away from inflation. So in which case, you have to ask yourself which one is more important right now.
At this time.
At this point in time.
So let me bring Professor Nana. Professor Nana, what do you think should be the priority at this time when we look at the reality of Nigeria's economy? I mean, the Development Bank of Nigeria, you deal with financial institutions. We know what IMF and World Bank are saying and all of that, but when you look at the reality of it, what the people are facing, what businesses are failing, what do you think should be the priority? Should it be growth? Should it be dealing with inflation?
Question. And I think we have a twin objective right now, and it's a twin problem at the same time. What I mean by that is Dr. Adedipe has said a number of things which I largely agree with. And to be sure, the speed and deceleration of inflation figures is much slower than I anticipated. So you have rural inflation, urban inflation, core inflation, all inching upwards, culminating in a higher headline inflation. Food inflation has come down a bit, but the truth of the matter is this. Food inflation has more to do with the fiscal side, more structural. And we are in the farming season, it's a raining season, so we should expect, in my mind, lowered prices simply because the government should have kind of dealt with the insecurity issues and so on. But since that's not the case at this time, food inflation is still sticky up. And because food inflation is largely the weight of food inflation captures more so any other thing we have in the inflation bucket, I still see inflation as a challenge, and MPC have a difficult decision today, and in my mind, albeit it's early days because we have a few more minutes before they make the announcement, but I still believe the trade-off is there. If you hike up rates, you sacrifice economic growth. But the growth GDP data is more of a fiscal issue. And that's where, in my mind, MPC members need to continue to signal to the fiscal authorities to perhaps slow down on or have more discipline in their house, in my opinion. Because in the end, if you continue to hike rates, what tends to happen is this will transfer to households and MSMEs. And we all know they're the engine of economic growth. And ultimately, they have a lower savings propensity. And if we know this is true, then growth GDP data for Q1 will come down, will be lower. GDP for Q2 will be lower and will not achieve the so-called target of a 3.1, 3.2 GDP for the year. So in my mind, it's a tough call, but hiking rates to fight inflation will not be the silver bullet the CBN needs right now. We need to look at the fiscal side and take some tough decisions there.
It sounds like the CBN is in a very difficult situation because they don't have control over the fiscal side. They have control over the monetary. But of course, we've been talking about the need for collaboration between both sides. And good enough, we do have a minister, a coordinating minister of the economy, who should be a bridge between both sides, the monetary and the fiscal. Do you see that collaboration going on at this time, or do you perceive that perhaps they're working on it?
I think it's a work in progress. There is a degree of coordination, but we need to see a stronger push for this. And I say this because when you take a look at the inflation figures, and when you take a look at the structural issues around insecurity, when you see those two things, you begin to question how much more coordination needs to be done by the fiscal authorities with the monetary authorities. Ultimately, you cannot hike your way out of this mess. The CBN knows this. All they have is a handful of tools at their disposal. So they have to go back to the fiscal authorities now to fine-tune some of the spending that's being done to make it more coordinated in a way that all Nigerians benefit from the overall reforms being done in the country. Because truth be told, there is a degree of reforms happening right now that will yield positive dividends in the medium to long term. But for right now, the pains are there. And the households, the MSMEs, those folks at the bottom of the pyramid, these guys are the ones feeling the pinch the most. So what can be done to help salvage, help support these immediate needs? And in my mind, the cash transfers, which the government has said they're doing, is a good start. But beyond that, I can see spending priorities to be tweaked a bit. Infrastructure projects are okay, but the reality is I see a huge housing deficit that needs to be, curbed. And to do that now means that all hands need to come together to achieve inclusive growth. Hiking rates is one thing, but that's going to pass through the economy. Everybody will feel the pinch, from the high net worth individuals to the poor man on the street. Everybody takes a hit.
Dr. Adedipe, I think Professor Nana sounds like, yes, it's good to deal with inflation, but you can't do it with just hiking rates. I mean, he did say you cannot hike yourself out of this mess. So, I mean, it just comes back to that situation where we do know that there needs to be more coordination and not just, he talked about food inflation, for instance. We know the factors driving food inflation in the country at this time, and that's beyond the CBN.
Correct.
Which may be the reason why the former administration, led by the former, Mr. Emefiele, did a whole lot of developmental, and we know the consequences of that. Everything does have consequences. So it does sound like the CBN is really in a tight corner. You can't hike yourself out of this mess, and yet you cannot be the one to control what's going on in the fiscal side.
And that brings the responsibility squarely on the table of the fiscal authorities. And the way this works, in my own interpretation, is this. As rightly mentioned, we know the factors pushing food inflation, which is actually the major culprit in the inflation rate we are battling with today in Nigeria. It didn't happen suddenly. This began almost 8 years ago, when we began to see the effect of insecurity on the farming community and farming belts throughout the country. And of course, the warning we sounded then was that if we did not address that urgently, we'll likely get ourselves into a situation where we are today, where two things will happen, and they're already happening. Number one is that we'll now be spending more money in terms of our external reserves to pay for food imports. That's already happening, okay? Secondly, is the fact that food inflation also will tick up significantly. So what are the critical factors in dealing with that? Yeah, the CBN might reach the limit of what it can do with monetary policy tools. There's a limit to that. If you check out, the statistics of it, what I found is in the region of 32-33% in terms of the impact of a hiking monetary policy rate on inflation rate. Look at the historical data, all right? So if that is the case, it means there are other factors that explain inflation in Nigeria. And that brings us back. So
I'd like for you to say that again. Yeah. The impact of inflation, of interest rates on inflation.
On inflation had been found statistically to be between 32 and 33%, looking at our historical data. And that just goes to, again, lend credence to the argument that the monetary policy rate is not sufficient to bring inflation in Nigeria under control. And so we now ask, what should the fiscal authorities be doing at this time? And that comes also to the issue of how we spend our fiscal operations on what? So then we point us in the direction of four things. For me, the first relates to what we commonly say in Nigeria about post-harvest losses. Oftentimes estimated at 58, 59, 60%. So, and that is why, for example, at this point in time, tomato is very expensive in the market because it is off-season, so the volume available in the market has reduced significantly, so it is now expensive. So, but the question is, during the harvest season for tomato, just using that to illustrate, and you have so much available in the market, typically the price will collapse, and then in a matter of days, few weeks, whatever is not sold goes to rot. So can we then begin to look at the fiscal authorities coming up deliberately with policies that will do two things? One is direct investment in infrastructure that will support reducing significantly post-harvest losses on the one hand, and then at the same time, looking at creating an environment that allows private investors to equally invest in such infrastructure. So quick, if we do, then we'll be looking at two things out of the four I mentioned, and that is processing as well as storage. Now, if those two are strengthened deliberately with fiscal policy, we are likely to reduce significantly post-harvest losses. Another major issue that affects food inflation in Nigeria is the fact that we do mostly rain-fed farming. We don't do all year-round farming, which then brings up the importance of irrigation systems. Again, a similar approach can be adopted, where fiscal authorities, in terms of projects and then public-private partnership models that will allow private investors to also come in that space. So if we invest in that direction, then we can produce all year round rather than only during rainy season. So in which case, we break the back of scarcity during off-season.
So our talk around dry season farming, we've talked a lot about
always limited in actual fact, because when you talk about dry season farming, it's only limited to locations where you have irrigation. That's what it means. So if we want to do all year farming, it means we must deliberately invest in irrigation systems. And the question running through my mind on making my way to the studio here today was, how long does it take to do that? Do we need years to do that? Now, what we are talking about can be a matter of a few months if we are really serious. Now, the connection to what my friend said earlier on, okay, is that when government invests in those infrastructures and creates an environment for private investors to come in the same space, it goes to impact the bottom of the pyramid. Because most of what we do in Nigeria in terms of farming is smallholder farming. And so to that extent, therefore, as big investors come in that space to do commercial farming, they are also networked and connected with the smallholder farmers. And so you create now a huge community of farming that produces sufficient foodstuffs to deal with food inflation and also temper our need to import food. Like, I mean, if you look at the data for 2023, put out by the Central Bank of Nigeria, we spent, I think, some $20-something billion or so to import food. That's quite significant. We could have avoided that.
And yet we are talking of FX and the value of naira. Precisely. So if we keep importing, then we're going to talk about that, the issue of FX and the value of naira. But first of all, let's show you the venue of the meeting. We are waiting, of course. The meeting is still holding. That's the venue right there. It's still empty. Members are still behind those walls that we're looking at, having conversations. And I'm sure at this time they're trying to wrap up to come to tell us what they have decided, the numbers, the monetary policy that the country will be running on until the next meeting in July. So that's the venue waiting. Once we have the central bank governor coming through those doors to take his seat there, as well as other committee members, we would be heading there. We can see some people coming out there, but this is supposed to start at 2 p.m., so I'm sure we'll have more activity going on right there. But that's where we'll be heading to in a couple of minutes. But let's just make the most of the time. Dr. Adenikpe did talk about the issue of importation of food. And we've seen what has been happening to the naira. Just when you're about to celebrate, you get a heartbreak. We had interventions from the central bank last week. Perhaps that is why we saw an appreciation in the naira. Professor Nana, yesterday there was an appreciation, but I guess we have learned our lessons now. We cannot just start celebrating. We don't know how long it will last, because all of this feed into the value of the naira, which also, of course, affects our reserve, affects inflation, and affects anything. I wonder if you see reprieve for the value of the naira anytime soon.
Well, I think when you look at the price discovery of the Naira. Right now it seems to be stable at around 1,400 to 1,500 thereabout. But price discovery is, in my mind, when we put all our heavy tools to use, meaning that we don't have the right prescription right now for the problems we have, meaning that when we're producing enough, then our Naira value will naturally gain and strengthen. But because at this point our productivity gains are eroded, and this is because we are changing more Naira to find dollar to buy goods abroad to bring it back in. Whether you want to call it a cost push or demand pull, either way, we are even exacerbating our own inflation issues. But right now, as it stands, I still see a lot of work that needs to be done. The price discovery, as it stands today, is between 1,400 to 1,500. In the next month or so, it might improve. But in the end, it boils down to our productivity. If we are able to produce more internally and reduce the level of importation of similar goods, then in my mind, we will start to begin to see a natural appreciation of the Naira. But until then, we are still going to be struggling at this sticky high point of 1,400 to 1,500.
Yeah, but it sounds dangerous, Professor Nana, to me at least, when you talk about production, because when we talk about, well, the low-hanging fruit there is the crude. The NNPC boss had said over the weekend that we're expecting about 1.7 million. I mean, we're far away from there now, and we're still dealing with oil theft. Now, when we talk about agricultural production, we know that you don't just put a seed in the ground and then it comes up. Even when we try to export our yam, we know what happened to it. So it's so scary because it doesn't seem like there are answers, accessible answers around us at this time. That means we might have to suffer this for even longer.
Well, yeah, I think we may have to persevere a bit more because, as a matter of fact, the government has already said the pains are going to be temporary and it's going to be very pernicious to all members of society. But like I said earlier, households and MSMEs feel the pinch the most. We have observed a lot of small businesses closing up right now, and that's because of the inflationary effects, amongst other issues endogenous. But if you take a look at what's happening in terms of overall structural changes in the economy, you can see some signs that, okay, perhaps in the years to come, we will see some marked improvements in the overall health of the economy. But for right now, the pains are real. It's for all members, but mainly for households and MSMEs. So when we look at, if you take a look at the importation of foods, for instance, when I look at the exchange rate at the ports, I begin to wonder, are we trying to continue to cause inflation internally? Because if the exchange rates to clear your goods is 1,400, 1,500, then obviously that business owner will obviously pass that price on to the ultimate consumers, you and I, who will go to the stores and buy those goods at a higher price. So we'll continue to see food inflation maybe inching downwards, but it'll be a function of the exchange rate. Because in the end, we're not producing enough internally, and when we do, I feel as though the prices aren't, in my mind, in tandem with what's happening in reality. So various jurisdictions will quote different prices, and there's a bit of price discrimination, especially on consumer goods. But overall, when we take a look at the food inflation figures, I feel as though that although it's coming down a bit, it's not coming fast enough. And that's why I pointed my hands back to the fiscal authorities to take a look at that side. Storage, which Dr. Didike mentioned, is a good start. Year-round farming is another point we need to take seriously. Irrigation is key, and irrigation, in my mind, should not be a long-term plan. That could be done within a few months, 6 months or less. We can solve that problem. Insecurity has been the bane of society's issues right now. And because insecurity is still there, I feel as though we will be challenged when it comes to food prices and so on. So strategic reserves need to be released. Security apparatus where we have the security officials guarding, I mean this in literal terms, they need to support the farmers because it's the farmers who feed the country. And we cannot expect to continue to import foods that we can easily produce here. It doesn't make sense for the Naira, it doesn't make sense for the people.
So, Dr. Adedipe, you prefer some solutions, and Professor No obviously agrees with you. Storage, dealing with post-harvest losses, insecurity, you know, if we should have security personnel, let them guard the farmers, let them produce what the nation will eat. Do you see, and don't forget, the president has declared a state of emergency on food insecurity. You know, so I believe the president does know the importance of being food secure, but the thing is, what fruit has that given the people?
Well, very good question there. And my thoughts around this is from the perspective of project management. Now, all these issues you mentioned can be brought down to projects. There are 3 Ps, as we call it. You start with the policy pronouncement made by the president. Then what programs will drive the implementation of the policy. Then for the programs, we derive now projects. Now, when you come up with the projects, you are very clear as to expected outcomes and timelines. So which then means that ultimately, what you set out to do is, if we are doing irrigation projects for certain locations, let's say throughout the 6 geopolitical zones, there are timelines set for when they should be delivered. And so there's proper monitoring and ensuring that they are delivered. So this, of course, means we can develop scorecards for track implementation. If they are properly implemented, they would have migrated from rain-fed farming into all year-round farming because of successful irrigation projects for the farms. Complement that with security for the farming communities, and then we are on the way to producing food we can cultivate here rather than importing them.
All right, Dr. Adedipe, we see that the governor of the Central Bank of Nigeria is now seated. I think in a couple of minutes or less, he would begin to speak. We do know that it's scheduled for 2 p.m., so this is just about 4 minutes or so to 2 p.m., and I believe he will start to speak. Let me just ask Professor Nana, before we head right there, Professor Nana, so what do you think the announcements will be? A hold, another hike, obviously not a reduction?
To be specific and brief, I would imagine it will be a moderate hike. If inflation targeting is the name of the game, a hike is needed.
What would moderate mean? What number? Have an idea?
50 to 100 basis points seems adequate.
All right. Okay. And Dr. Adedipe also agrees. 50 to 100.
50 to 100. Yes.
Okay. We'll see. We'll see how that goes. But nobody's thinking there'll be a hold in the midst of the threats to
I don't expect a hold because the rate guidance the CBN governor gave is in the direction of this policy direction will still be
will still be in order.
Yeah.
And what if impacts do you think that would have if we have a 50 to 100 basis point?
Well, that's the interesting part to it because it will affect not only the markets for Naira assets, but as we mentioned at the beginning of our conversation, also the loan market. Loans become more expensive. That can spell trouble for the borrowers and even for the lenders as well. And of course, on the other side, the flip side, Naira assets will become more attractive to investors domestically and also foreign investors. So a further hike, therefore, can still ignite interest that can trigger FX inflows by foreign investors that see Naira assets that now are also marked up more attractive. Then domestically, it will align with the target of central bank because Naira assets now commanding more return. We also help to mop up liquidity, which is in line with dealing with inflationary pressures.
Well, Professor Nana, if this happens, Dr. Adedipe sees the Naira assets more attractive and all of that. But we have also been warned that, I mean, this type of assets and investment is hot money, and it can leave at any time and cause another kind of trouble.
Yes, that's true. But hot money, when rolled over a couple of times, becomes cool money. So I think right now it's okay to have hot money coming in. In the end, it boils down to my focus remains on households and MSMEs. If rates go up, the lending rate shoots up, and it almost happens instantaneously. And because borrowing costs will shoot up, it also implies that you're sacrificing a degree of economic growth, because everyone now will be pinching pennies and trying to ensure that their bottom line is preserved. So right now is tough times for the decision makers at the MPC, but it's going to be interesting.